Good afternoon, everyone. My name is Mugdha Lele, and on behalf of the TechX.in team at Venture Center, I'm happy to host the third wave of our Only One Theme Awareness Talk series on innovation management. I welcome you to the third talk in this wave of Only One Theme. Today's topic discusses ESOPs and SARs, and this we are going to do in two parts. Part one is to introduce you to share-based compensation. And our speaker for these talks is going to be Ameya Kunte. Let me briefly introduce Ameya before we begin the talk. Ameya is the founder of Globeview Advisors, a boutique consulting firm specializing in tax-centric advisory work. With over 21 years of professional experience, Ameya specializes in advising on domestic and cross-border transactions, mergers and acquisition deals, and a global transfer pricing, serving diverse clientele across sectors like tech, pharma, IT, real estate, e-commerce, fintech, and so on. Before founding Globeview, Ameya worked with top firms like Ernst & Young and PwC till 2010. In 2011, he started his entrepreneurial journey by co-founding Taxsutra, a leading B2B tax news and information portal in India, where he served as co-founder and executive editor until 2019. Ameya is a respected speaker at various global and Indian forums on tax. He also serves on the board of VRI, an automotive component supplier in a US-India joint venture. He is also an active member of committees such as the ICWA, the Chamber of Tax Consultants, and other organizations. Fundamentally, he is a chartered accountant and a commerce graduate from Pune University, securing top ranks in several examinations. Beyond his business ventures, Ameya also enjoys teaching at the ILS Law College, Pune, and is associated with an NGO Doorstep School for over 15 years. Ameya, with this brief introduction, welcoming you to the session and handing over the session to you.
Thank you. Thank you, Mugdha, for the introduction, and thank you, Venture Center, for hosting me. My apologies. I think suddenly some background noise in the neighboring office has started. I'm trying to fix it. I hope it's not too bothering, Mugdha.
No, it's not been heard. Don't worry.
Thank you. Thank you, and good evening, everyone. I can also see Shruti and Dr. Premnath in the attendee list. So, good evening to all of you. And like I said, thank you to Venture Center for giving this opportunity to interact with wonderful professionals. The topic for the session for next 15 minutes or so is around the share-based payment, or ESOPs as we commonly sort of understand. I am also joined by my colleague Chirag Chodia, who's also CA with our consulting experience. Chirag will also be adding some comments as we sort of progress in this session. Chirag, could you put together a presentation on the screen, please?
Sure.
So, as has happened in the previous sessions, and as Mugdha would have articulated, feel free to raise your questions in the chat box, and as and when I find a right time to take up those questions during the session itself, I will deal with those questions. And of course, at the end, time permitting, we will also have time for further Q&A. So happy to take as many questions as you have. And on the concept, I'm sure ESOP is not new to many of you. Some of you are running startups and have issued ESOPs to some of the core employees. Some of you may be recipient of the ESOPs and are thinking about challenges around tax, liquidity, and so on. Some of you are from academicians and legal background, would probably know better further nuances around swap and the SARs and the FEMA implications around it. So we'll try to deal with this topic. Like I said, I'm aware that most of you would know some concepts around ESOP, but we'll try to go through the basic aspects and then go to some of the critical issues around ESOPs. What happens when the share-based transactions are to be entered with a non-employee? Some of the patrons, for example, in the early days of startup, what is the concept of under company law, we know ESOP, but there's a concept of a sweat equity as well. What is sweat and how is it different from ESOP? We'll try to deal with all of these points over the two sessions. In today's session, we will focus mainly on what is the conventional employee stock option or the ESOP, and some of the commercial legal aspects of it, and of course the tax, which plays a very critical role on the liquidity as well. So this is what we will cover in today's session. And in the next session, how the share-based payments are to be, or compensation is to be given to the non-employees, and some of the advanced strategies around managing the ESOP well is what we will discuss. So this is how today's session and the next Tuesday session is split. Chirag, we could go to the next slide. So these are the two common terminologies which I am sure you would have heard: ESOP, and another variant of it is called as SARs. There are a few more variants too, but I've primarily focused from a conceptual standpoint. These two approaches work. What is ESOP? As the name suggests, there is an option. It means that a company which otherwise issues shares to the shareholders, it issues options to employees. The options will eventually convert into the shares. So in a sense, it is a right to purchase the shares at a specified price, which is usually a discounted price. So let's say you are part of the startup, the value of the shares today is 10 rupees, and everybody believes that the startup has a great potential, and the value will go from 10 to 500 in a 3 years time. And you will get those shares maybe at a 10 rupee, maybe at 100 rupee as per the commercial term. So it is allowing an employee a right to purchase the shares at a usually a discounted price. So an employee actually becomes a shareholder in the company and holds the equity share. So this is the essence of what is ESOP, that you actually become a shareholder in a company and shares are allotted. It of course means that there is a dilution for the promoters as well as the investors when the ESOPs are created. Typically, instead of a single ESOP company, the founders and the promoters decide what is called as a ESOP pool. So let's say 5% or 10% of the equity is earmarked for allotting ESOP to the employees who are eligible and who meet the conditions of the ESOP scheme. Now, in ESOP, there are different ways it could be structured. Sometimes the employer expects the employee to pay for the ESOP, and Vasudha has raised this question that does the employee pay for the share? Uh, it depends on the scheme. Most of the times, it's a nominal value which the employee pays at the time of exercise of the ESOP. And we'll go through in the subsequent slides, go through the entire journey of how the ESOPs sort of pan out, what is the life cycle, and I'm sure you will have more questions. But employee pays, sometimes employee gets it free of cost also, and employee essentially becomes a shareholder. It also means that there is no cash outflow from the company or the employer. If an employer has to hire a very talented employee or a professional or a person, uh, maybe the company today doesn't have a money to pay in cash the salary or the remuneration, in which case the company agrees him or her to reward with the issue of the employee stock options in such a way that that person participates in the value creation at the company level. So this is a classical sort of feature of a ESOP. On the other hand, there is another concept called SARs, or stock appreciation rights. But before we deal with SAR, Mugdha, Vedang, I just want to double check if the audio is correct, and I hope if the screen is also okay. Just want to recheck before proceeding.
Yeah, everything is fine, Ameya. You can proceed.
Perfect. Thank you. So SARS is the other concept, in which case, where employee is receiving a, a right to encash the appreciation, the value of the stock over a period of time. Uh, Employee actually is not awarded an equity share, but again, in our example, uh, today I join a company and the per share value of the per share value of the company is 10 rupees. And let's say 3 years down the line, everybody believes that that value will go to 400 per share. A typical stock appreciation right agreement will say that company shall compensate the employee uh, an amount which is linked to the appreciation, the value of the share. So if the share goes from 10 to 400, effectively 390 is the appreciation which the company will compensate by way of a cash outflow or like a bonus. So in terms of the value creation, maybe the employee gets a similar value as the ESOP, but the big difference is that employee is actually not a shareholder and doesn't enter into the cap table. On the other hand, SARS is results in a cash outflow for the company. So company in example one is actually not paying 390 rupees when they issue ESOP, whereas in SAR based approach, company there is an outflow to the extent of the appreciation, the value 390 in our example. So these are the big pluses and minuses. Of course, SARs are also not very efficient from a tax point of view because the whole of the amount is taxable as a salary, and there is a TDS also applicable in the context of SARS as well. In ESOP also it is, but there is a timing difference which is really a big plus. So SARs typically are issued. Uh, I have not seen commonly being issued in the Indian startup ecosystem. They are issued mainly by, I've seen them being issued by the large listed corporations where they have what is called as a treasury stock, which really funds these cash outflows from the employer to the employee. So in a Indian sort of startup system, I have seen ESOPs as a most common sort of method. Rajul has asked a question on the tax liability. Hold on to your question for two more slides, and I'll deal with it in detail as well. Chirag, shall we go to the next slide? Right. So, what are the benefits? I think all of you know that ESOPs or share-based compensation uh, creates a great opportunity to the employee to participate in the value creation. From a founder's point of view, it is a cashless payment that happens, and there is a long-term value creation for the employees. There is also a very important aspect of employee retention, which is achieved by way of a ESOP. Typically, employee stock options, when they are issued to the employees, they are actually they become encashable at a later stage after certain milestones are met, which typically can take anywhere between 1 to 3 years. So, in a sense, an employee automatically is incentivized to stay back till the value encashment opportunity arises for the employee as well. So, it automatically acts as a employee retention tool as well, and of course helps in attracting the best talent and productivity. Chirag, will move to the next slide. Right. So this is a very important part. There are 5 phases in a ESOP. Phase 1, 2, 3, I've discussed on this slide, and 4 and 5, there is a specific separate slide because it's the most important sort of phase as well from a cash flow, from a tax point of view, and so on. So the first point is the ESOP strategy. So So a lot of times, uh, at the time of course, hiring, a lot of startup founders start thinking, and maybe to attract the talent, as I mentioned earlier, they think of introducing ESOP, which can happen in a bit of a haphazard manner where founders say, okay, I commit to you 1% of the stock. Maybe they take a CTO and tell him that I'll commit 3% stock, provided you do ABC, and so on. So having this strategy is very, very important at the early stage of the startup. What I mean by strategy is that I have seen private limited companies having no visibility or a plan for a liquidity event in the near future. At that time, having ESOP is actually not necessarily very effective because if in a reasonable period, let's say 3 to 5 years, employer is or the founder is not able to generate the liquidity, uh, you know, uh, or take the company public where there is a potential for liquidity, it becomes very difficult proposition for someone to just accept a piece of paper. So one has to have a visibility between the next 3 to 6 years to create a liquidity event uh, or make liquidation opportunities for the employees. So the stage of introduction therefore becomes important. The second aspect is the coverage and eligibility. So which team members are eligible? Uh, who do you extend this to? I'm sure you've heard stories of Infosys giving ESOP to the drivers as well. Uh, of course, those were different times, but today you have to be a bit selective, and of course, uh, whoever is critical to the value driver of the company should be part of the ESOP plan. uh, the next aspect is the vesting factor, and there is a concept of when you grant the ESOP typically, so grant is, let's say, day zero, and then the employee stock option scheme will say that for an employee, let's say you have 100 options. Let's say 50% shall vest in you after 2 years, the balance 25 years at the end of third year, and balance 25 at the end of fourth year. Now, this timing and the percentage is very, very crucial. Uh, let's say a CTO who's doing a product development, what is the most important phase of the product development? You have to align your ESOP vesting to such a person. If it is, let's say, a marketing or a sales driven person, the key outcome and the vesting schedule also sort of has to align as well. And therefore, what are the vesting factors? Is it the time? Is it something else needs to be decided, and it needs to be articulated very, very clearly. And mode of compensation is also a right mix of cash and non-cash component. I mean, founders would want to hire an employee without paying cash. So at the same time, there has to be a there is usually a demand for a cash component, and therefore having the strategy around cash and non-cash component is also very, very important. So it is overall philosophy of how you are rewarding the employees and how ESOP fits into the strategy becomes very, very important. Now, there are a few questions over here in the chat box. Will there be a vesting period for the stock appreciation rights by default? And in which situation SARs are to be chosen over ESOP? I'll address both these questions. So vesting period for SAR, uh, in a sense, since there is no physical instrument which is issued, there is no concept of vesting of a share, as in SARs, actual share is not allotted to the employee, but your ESOP scheme will tell you that you will be entitled to a SAR-based payment at the end of, let's say, 2 years or 3 years, or after so and so milestones are achieved. In a way, that becomes akin to your vesting factor. If, for example, employee leaves before the vesting, usually the ESOPs or for that matter, SARs would lapse. So in that sense, the vesting period is defined by the contractual obligation in a SAR as well. And Ashish asked question as to why would a company choose SAR versus ESOP? Like I said, uh, most I have seen SARs being issued mostly by US tech companies or US, I mean, multinational companies where shares are listed, and typically these shares are tradable. So company keeps certain shares, as they call it, as a treasury shares. Company buys it from the market, keeps it in a trust, and pays this amount to the employee by selling these shares in the form of SARs compensation. In that scenario, company is actually able to generate a cash flow and pay to the employees. In a conventional Indian startup, uh, most of the time startups don't have cash to pay salaries to the employees, and which is why they are choosing equity-based compensation where company is preserving cash. So used in the limited situations and mostly from the multinational companies. I have seen a less instances in the Indian startup ecosystem. Uh, we'll move on to the next point, which is planning the ESOP. Now, planning the ESOP, there are two, three aspects. One is, of course, the philosophical and the strategic part that we discussed earlier. Then, legal is very, very important. When I say legal, primarily the company law provisions and the company rules are extremely important, um, and we'll see some features of the company law provisions in the later slides. But to give you an example, um, a a promoter, for example, is not eligible for ESOP itself. Now that's a company law requirement. There is a relaxation given to a startups, but otherwise promoter cannot himself receive a ESOP. Now, this is a legal provision which you must sort of know, and therefore planning becomes important. Second, documenting the key terms around the ESOP. So, what happens during the phase of vesting? What if the employee leaves? The good leave and the bad leaver concept. Would you like to bake that in? More importantly, after the shares are vested and employee exercises and becomes a shareholder, as a shareholder, he gets various rights under the company law. Uh, do you, as a founder, want to keep, for example, the drag along rights on those ESOPs? So those are the planning aspects which become very, very relevant because usually at a early stage of the startup, founders are very keen to get the talent on board, and they would therefore end up making a lot of commitments, which maybe after the business grows and becomes large, they become it becomes at times commercially difficult to sort of fulfill those conditions, and therefore that ESOP plan becomes a crucial sort of aspect. The vesting exercise conditions, deciding the pool and the size is also important. Should the ESOP pool be 5%, 7%, 10% is also equally important. And typically, before a startup brings the investor on board, before that stage, having an understanding around this becomes very, very crucial because if you introduce a ESOP pool at a later stage, after the investor has come on board, invariably the founder gets ends up diluting as well. So these are some of the planning aspects that a startup and a founder has to do. The third stage is the grant of the option. So on day zero, company sort of rolls out the ESOP plan and grants the ESOP. It's a contractual document which provides the different terms and conditions. It also articulates a communication as to which of the employees are eligible, how many options they are eligible, grant price will as Vasudha asked at the beginning, will an employee be required to pay any amount to exercise if it is a nominal amount, and so on and so forth. So these are the aspects. So at this time, actual documentation will be issued by a company saying, "Hey, employee, you are eligible for so and so options." Uh, and these are the sort of conditions which are there. So these are the first sort of three building blocks: strategy, plan, and the actual grant. Let's now move to the vesting condition. Now, what is vesting? It sounds a very sort of a very legal terminology. Vesting essentially means that as per the contract between the employer and the employee, after a particular period, employee becomes eligible to exercise the ESOP. And this period is called as a vesting period. It could be 1 year. Company law provides a minimum vesting period of 1 year. But this is the period where, in a sense, employee is providing his services and adding, in a sense, the value. And at the end of the vesting period, he or she becomes eligible for exercising the shares as well. So the vesting is very, very crucial date. Completing the vesting milestone is a very important aspect from an employee standpoint as well as from an employer standpoint, because that's where the obligation to issue shares or receive shares sort of kicks in. Now, um, so the first aspect is, of course, monitoring of the employee and their conditions, and are they sort of uh, delivering what has been sort of expected of them and as per the ESOP scheme. And completion of that is the first important aspect. Uh, Now let's look at a few aspects from a accounting and tax standpoint. What happens during the phase of vesting? Now, during the phase of vesting, again, employee is not a shareholder, he's not on the cap table yet. But a company in the books of account needs to record the pro rata expenditure of the fair value of the ESOPs. Now, this helps. This is very crucial from a profitability standpoint, because your ESOP, proportionate value of the ESOP, gets added as a expenditure. Of course, there is no cash outflow, but it impacts your uh, your profit for the company as a whole. So let's take an example. We saw earlier an example where a share is issued worth 10 rupee today. At the end of 3 years, the price is 400. So in a sense, there is a benefit of 390 over a period of 3 years of vesting. Now, a company has to record one third of this expenditure in its profit and loss account as an expenditure. This will be a non-cash expenditure. This is the key impact on the books of accounts. Uh, Third aspect is this expenditure a deductible expenditure for the company? The answer is yes. There have been some tax jurisprudence, but more or less we've settled that a company would also get an expenditure break for this ESOP. Um, and the fourth aspect is lapsed options. Uh, uh, you know, Taking the NOCs from the employees. So at the end of the vesting, if the employee, so typically at the end of the vesting, employee is given a window that within certain period of time, let's say 1 month, 6 months, 1 year, you can actually exercise the options. If you don't exercise those options will lapse. So I was eligible, let's say, 30 options at the end of second year, and the plan provides that within 12 months I must exercise these options. For whatever reasons I choose not to exercise, then the options sort of lapse, and paperwork around lapsed options is also small but an important aspect. um, there's a question from Rajul as to what kind of a discount is given for buying stocks, uh, and is it also given at a zero cost? So, Rajul, as I mentioned earlier, um, and Vasudha also asked this question, that uh, ESOPs, and let's continue with our example. Let's say I'm an employer, and today the the value of the the share is 10 rupee, which is a face value. Now I expect that the value will go to 400 rupees at the end of 3 years. Now I could devise a ESOP scheme in a way that upon exercise, at the end of, let's say, year two, employee has to pay only 10 rupees to be eligible uh, for this for this share. I could put a price of 50, I could put a price of 100. It's really the commercial call. Now you have to now think from a both, you wear an employer's hat and an employee's hat. Let's first wear an employer's hat. If I tell the employees that when you get these options worth 300 rupees, but for that today you have to pay 100 rupees. uh, the question is, as an employer, will I be able to incentivize the employee to actually exercise these options? Because let's say if I have 1 lakh, if I have 1,000 options and I'm required to pay, uh, maybe 1,000 uh, a different number, but let's say, if I'm required to pay a crore at the time of exercise, and the value of these ESOPs, the upside is, let's say, 10 crores. I whether there will be enough motivation for employees to put in that much of a money. I think that's the question, and that's the part of the strategy. So should the exercise price be zero, or should it be X% of the fair value? It's really the commercial call. Even from an employee standpoint, uh, when I again exercise the options get converted into shares. It is of course a valuable asset, but today it is still, there's no hard cash on the table. So is an employee, uh, will he sort of feel motivated enough that, oh, but to get this share, I have to shell out 50 lakh crore, 5 crore. Uh, then, chuck it. I may not want to exercise it. So this is where the effectiveness becomes very, very crucial of the ESOP scheme, and how much exercise price do you put. Theoretically, you can put it at zero, you can put it at 100%, you could put it at 50%. It's really the employer's call, and uh, really you need to make the scheme work. I think that's the bottom line. Now let's look at the stage of the exercise. So exercise is a stage where grant has happened, the vesting period has happened. At the end of vesting period, employee has fulfilled all the conditions, and let's say I as an employer, I as an employee, I am eligible to exercise, let's say, 100 options uh, at 10 rupee per option. Uh, Now here several sort of tax implications become relevant, and I want to sort of deal with one by one. The first point is that there is an income tax which is triggered for the employees, and therefore there's a TDS which is required to be done by the employer. So let's take an example. Uh, in our example, uh, the benefit is 390, and let's say there are 100 sort of shares that I've exercised. So effectively, 390 multiplied by 100 uh, becomes really the value of the perquisite or a taxable salary, and becomes taxable in my hands as an employee's hands. Typically, uh, the ESOP schemes also at the provide who bears the liability for the tax cost. Is it the employer or the employee? I have seen in most of the situation that it is the tax cost on the exercise of the ESOP is to the employee's account. So in this example, this cost of 390 into 100 multiplied by whatever is the tax rate, let's say 30%, that tax has to be paid by me. Now, again, look at a very fundamental point from an employee standpoint. Instead of option, he's getting shares. So it's again a right or a paper in that sense. The tax on this goes out of employee salary. So this becomes a cash outflow for the employee, and this is a major sort of aspect. And I gave an example of value of 400. Let's say if that value is per share is let's say 40 lakhs. and I'm getting 100 shares, suddenly the way I look at ESOP exercise becomes different, because on a 4 crore worth of ESOP, there is a tax of almost 1 crore, which is going out. Do I want that tax cash outflow to be done today? Is a question that I have to sort of think about. I On the next two slides, there is a detailed example, so that it becomes more clearer for you. I'll of course deal with it as well. The second aspect is the withholding tax. So the moment there is a ESOP which is exercised, um, employer is required to deduct the tax on behalf of the employee. So in a sense, will recover it from the salary and pay it as a TDS to the government. So there's an obligation on the employer as well. The third aspect is that ESOP, because it is arising from the employment contract, GST is not applicable. Because there's an employer-employee relationship in case of a ESOP. And then the fourth point is deciding the timeline. Should you exercise the ESOP closer to a liquidity event? And this is a big question. Most of the times, because of the cash flow situations, employers or the employees defer the exercise closer to the actual liquidity event, so that there is a cash available to pay the tax as well. And again, we'll see this through an example on the subsequent slide. And the next point is allotment of share. So actually, employee becomes a shareholder. In a way, employee then also has access to the full books of accounts. So there is a bit of a cultural aspect which also has to be considered. I have seen founders, they want to issue ESOP, but they are not okay that employee gets to see the full sort of financials as a shareholder. Now, one has to keep it in mind that once an employee becomes a shareholder, he has full access to the audited financial accounts. He can attend the annual general meeting, etc., etc. So it has to be therefore a bit of a cultural aspect when you sort of issue ESOPs as well. Shall we move to the next slide? Rahul, I'll deal with your question and example. Chirag, maybe I'll take this slide, and the next slide you could sort of explain. So here is an example. There is a stock option given to Mr. A. The exercise price is 10 and the fair value of the share is, let's say, 20. Today, there is no implication for a company or Mr. A, because this is a step one where the shares are granted, the ESOPs are granted. ESOPs are granted to the employee. The step two is a vesting period. So the vesting period is, let's say, 3 years. At the end of 3 years, Mr. A can sort of exercise these ESOPs. At the end of year 3, let's say the share price has become 30 rupees. Now, just to recap, during this vesting period, the company can claim an ESOP expenditure, which will be 30 minus 10 into 5,000 shares, and that's apportioned over a period of 3 years. So this is straightforward. Now, in step 3, Mr. A exercises all the options, and at that time, let's say the share price is 50 rupees per share. Now, what are the consequences that will happen? The first step is when Mr. A is exercising the shares, 5,000 shares, and exercise price is 10. So the Mr. A has to pay 50,000 to the company, or company will receive 50,000 rupees for allotment of shares. The step 2, company has to then allot these 5,000 shares to Mr. A. There is no cash outflow for the company. Mr. A becomes a shareholder. Company records the balance expenditure as well. Bullet 3. The last bullet on the slide, this is important. Now, here Mr. A has exercised these options, so there is a tax consequence. What is the tax consequence? Is the fair value at the time of exercise, which is 50 as appearing in step 3. As against that, employee has paid 10 rupees to the employer. So the balance 40 rupees per share is taxable as salary. There are 5,000 shares, so 30% of it becomes the tax cost for the employee. Now, this tax in our example 60,000, this tax employer has to deduct by way of a salary TDS. Now, again, there is no money equivalent to the ESOP in the hands of the company or with the employee. So company or the employer will say that this 60,000 I will reduce from the other salary that that the company is paying to the employee. They will reduce this 60,000 TDS and pay on behalf of the employee to the government. So in a sense, here you've got shares worth 5,000, and for that there is a cash outflow of 60,000 rupees. So this is really, there's one intangible that has come in, and there is a cash outflow on account of tax that has gone out. Now there is a step 4 also, that could happen. Uh, a couple of years later, there is a liquidity event, and Mr. A is able to sell all of these 5,000 shares at a price of, let's say, 100 rupees. Now, at that time, what will happen is that for Mr. A, he sold 5,000 shares at a price of 100. So that is his sale price. Now, from this sale price, he can reduce the amount which is already taxed as a ESOP perquisite. So, in step 3, 5,000 shares into 50 rupees is really the cost that employee has already incurred and has paid the tax. So really the differential between this 50 rupees at the time of exercise and 100 rupee at the time of sale, this difference is what is taxable as capital gain. And as you know, usually a long-term capital gain is taxed at the rate of 15%. So the whole gain between 10 rupees to 100 rupees gets bifurcated into two parts. Part 1 up to exercise is taxed as salary and at a normal tax rate, usually 30% plus surcharge. And part 2, which is capital gains, is taxed at a, assuming it is a long-term capital gain, it is taxed at a lower rate. So this is how the taxation would work. Chirag, before we go to the next slide and you sort of applying, before you explain the conundrum, I just will deal with the some of the questions that have come. So Ashish has asked a question that should ESOP or SAR exercise be considered as capital gain since it represents the share appreciation over a time? So answer is economically, conceptually, yes, but given the way the tax law is worded, the first phase up to the grant and the vesting and the exercise, all of it is treated as a employment income. In fact, I would say that the Indian tax law is a bit liberal, and it allows the taxation event not at the time of vesting, but at the time of actual exercise. So, in our example, at the end of step 3, Mr. A may not decide to exercise the options, but he could hold on to his exercise for some more time, and that way he could delay the tax outflow. So the overall gain is split into two parts. One is a compensation, and the second part is a capital gain. When is Mr. A paying 50K? So he's paying this amount at the time of step 3 when he's exercising the share. So at the time of exercise, he has to sort of contribute 50,000 to the employer, and only then he'll get the shares. Chirag, shall we move to the next example? Bhupendra, I'll deal with your question, after the next example.
Yeah. Okay. So taking ahead from what Ameya just discussed, that this taxation of stock options is to be dealt with in two parts. Part number 1 is when it is taxed the salary at the time of exercise, and part number 2 is taxation as capital gains when the employee ultimately sells those shares. Now, as Ameya already mentioned that at the time of exercise, they're kind of a cash flow situation for the employee. And hence employees might prefer from a cash flow standpoint to exercise the shares once they have a visibility on the liquidity event. Uh, let's now look at two examples. There's Mr. A and Mr. B. Both have received equal number of stock options in 2020. The difference is that Mr. A exercises the stock options in 2024 as soon as they were vested, but Mr. B does not exercise it immediately. He waits until 2027 uh, when he sees a liquidity event. Both Mr. and Mr. B then sell their shares in 2027 at then existing sale price. Let's look at how the tax would be calculated for both of the individuals. So for Mr. A in 2024, since he is exercising the shares, the amount of difference, which is 5,000 multiplied by 100, which is the share price at the time of exercise, the salary tax would be applicable on that particular amount. This tax amount comes to 1,50,000. Now, since he is selling the shares after 3 years in 2027, this will result in a long-term capital gains tax. As you all would be aware, the holding period for long-term capital gains is 2 years, and the tax rate is 12.5% before surcharge and cess. So this gives a good tax advantage for Mr. A because his increase in share price from 100 to 400 is taxed at a tax rate of 12.5%, resulting only in a tax outflow of 1,87,500 rupees. And his total tax outflow in this case comes to somewhere around 3,40,000 rupees. Now let's look at Mr. B. Since he had a cash flow situation and he didn't want to exercise the shares until and unless he sees a liquidity event, what will happen is that he'll pay salary tax in 2027 when the share price was about 380 rupees. So he pays about 5,70,000 tax cost at a rate of 30%, which is applicable on salary. Then, since he is not holding shares for a period of more than 2 years, his capital gains would qualify as short-term capital gains. And even the differential 20 rupees between 400 and 380 would also be taxed at a rate of 30%, resulting in a tax outflow of about 30,000. And his total tax outflow comes to 6 lakh rupees in this particular case. So from this example, you can see that, exercising shares or exercising options well before liquidity event can certainly give you a tax advantage. At the same time, it comes at a cash flow. You have to manage your cash flow from other salary at that point of time. So this is what I just wanted to convey through this case study. Ameya, would you like to add anything on this?
Sure. So this is a classic sort of ESOP conundrum. So many situations where everybody is happy when the ESOPs are granted vested, but when it comes to exercise, tax becomes a bit of a challenge. Now, in case of Mr. A, he believes that incurring the tax outflow of 1.5 lakh in 2024 is worth because he sees a value to grow and maybe a certainty, in that value as well. So he in a sense incurred that cash outflow and is willing to take that risk. Uh, Tomorrow the value could go down also, mind you, because these are shares. Whereas Mr. B, who may have a conservative mindset, he does not want to therefore exercise these shares in 2024, and assuming his ESOP scheme gives him that flexibility, he defers and maybe he feels that okay, I will see the cash and then pay the tax. So these are really thought processes of each individual, and depending upon various circumstances, each employee has to sort of take a call. But this conundrum is something which we have seen in several startup situations when the ESOP exercise becomes due. Now, there are a few questions, Chirag. Let me deal with those. What if employee is not working at the time of step 3? So step 3 in the earlier slide was a situation where employee, there's a vesting and exercise, and at that time employee is not working. As I mentioned, Bhupendra, earlier, typically the ESOP scheme will articulate or it will put the rules of the game clear. Most of the times, if an employee he leaves the employment before the vesting stroke exercise, the options lapse usually. Uh, that's what the employer would say. So if I'm an employer, that is what the condition I will put in, because I want that employee to sort of continue at the time of exercise. So the options would lapse, and therefore commercially you are not been able to, you're not even entitled to these ESOPs. If for any reason the employer and the exiting employee commercially negotiate, then it will not be a ESOP, it will be a share-based compensation, and we will deal with the consequences of it in the part two. But you will therefore attract a sort of different sort of tax consequence over here. Um, now, Praveen asked a question around this point as to how do you calculate this fair value? I mean, in our example, 400, I mean, 400 is a fair value, or 100 was a, another fair value. So typically, so there are two aspects. One is there is a fair value in founder's mind, in employee's mind. There's a fair value which which happens along with the transaction. If a third party transaction happens, these two values, we will put them in a different bucket. For tax purpose, at the time of exercise, a company has to sort of obtain a merchant banker valuation certificate to arrive at a fair value. This fair value theoretically should be same as the transaction value or the value in founder's mind, but practically I have seen that to minimize the tax outflow, uh, employers tend to give a conservative estimate so that the fair value is lower and therefore the tax cost is lower. We have seen that this becomes a bit of a difficult aspect, because later on when you are, let's say, 6 months down the line, there's an external transaction, you've already sort of created an internal benchmark. Of course you can explain this was the internal benchmark, but this is again the part of the larger conundrum that we just spoke on ESOP exercise. um, so ESOP agreements where exercise is allowed only during the liquidity event is very common, and like I said, this is a situation of a Mr. B. Uh, it entails a higher tax cost. So it really depends on the employee's wish list or a preference, and his risk appetite and a liquidity appetite, to decide when does he sort of do the exercise. That's really the key aspect. Chirag, let's move to the next slide, which is the last slide. Mugdha, I will take maybe 3-4 minutes more and then we'll pause for today. Of course, we can take more questions too.
Yeah, sure. Let's see.
Sure. So we heard so far about employee stock options, ESOPs. There is another term called as sweat, or the sweat equity. Now, this sweat equity uh, is a concept provided in the company law, where sweat can be sweat equity. It is actually issue of equity shares by the company, not like options. So company actually issues shares. Now these shares are issued in consideration, the second box as is appearing on the screen, it is issued for providing a know-how or making available intellectual property or a value addition. So it is for a specific IP sort of transfer or a specific service over and above the regular employment that a director or employee is providing, where the sweat can be issued. There are certain company law conditions, and I won't sort of bother you with those details. But just a conceptual key difference between ESOP and a sweat is that sweat, there is a like a lump sum bullet sort of issue of sweat equity, or there is an actual issue of equity based on contractual terms. Uh, from a tax point of view, the moment the sweat shares are allotted to the employee or to that director, it becomes taxable. Whereas in case of a ESOP, there are sort of different vesting conditions. So fundamentally, the architecture or the commercial framework is different. In ESOP, you are telling an employee that you work, you add value, you stay with us, and then you are eligible for so and so options. In Sweat, usually I will say that, okay, Chirag is providing me is parting a valuable intellectual property. I value Chirag's intellectual property around, let's say, a code to be, let's say, 25 crores. And I say that instead of paying cash 25 crores, I am allotting you shares in the company. This is different from the ESOP, because in Sweat, you're required to specifically value that know-how transfer or that IP transfer. And of course, from a company law standpoint, there are certain conditions, and the Sweat allotment immediately becomes taxable. Can the same person be given Sweat and ESOP? Answer is yes, because except that if he's a promoter or a director holding more than 10% equity, ESOPs cannot be given. But a normal employee can receive both Sweat as well as ESOP as well. There's a question from Praveen that for raising the funds we do merchant banker, but for ESOP we just go with the book value, which is much lesser. Uh, as per the tax rules, the tax rule is very clear that that book value approach, uh, I mean, the tax rules specify how to determine the fair value, and the law is very clear that that fair value is decided based on the merchant banker valuation report and not based on the book value. So, if you do ESOP tax with the book value, you do attract a tax risk to sort of justify that merchant banker value is, because then a tax officer can order a sort of external valuation at that point in time, and then both employer as well as employee are carrying a tax risk. That is the consequence. So, like I said, idea of today's session was to give you a introduction to the ESOP concept and introduce with the based tax scenarios. Uh, I think we have a couple of more minutes. I can take more questions, but till that time, in the next sessions, what we will cover is what happens if you are not a company but a LLP or a partnership. Then how do you administer ESOP? Then there are certain startup related relaxations. How do you sort of take benefit of it? The third aspect is if you are not an employee, but let's say I'm rendering my consulting services or a social media services to the founder, and founder wants to compensate me by way of a ESOP, not ESOP, but a share-based compensation, then what is the tax consequence? So these are some of the aspects we will cover in the next Tuesday session. Um, any questions? I'm happy to sort of take them. We we
Yeah.
can extend maybe 1 minute.
We'll just wait for a few more minutes. There might be few more questions, but let me just alert everyone. The feedback link is in the chat box. So please do give your feedback before you leave the session. Yes, there's a question from Raju.
Sure. So in case of Sweat, uh, like I said in the example that I gave, I'm valuing Chirag's IP development and transfer at 25 crores. If Chirag is an employee and he gives it to the company, uh, it becomes taxable as salary in Chirag's hands, and then the company has to do the TDS and pay. Of course, there will be a cash flow issue, so company and employer and employee will have to work out as to how the cash flow will work, who will fund the TDS, but there will be a tax of salary tax on the 25 crore, which is paid by way of Sweat. This is how the consequence will happen. Thank you, Dr. Premnath, for your comment. Appreciate. ESOP agreement template. I mean, I have seen there are certain boilerplate templates available on how the ESOP schemes work. You could start with those, but I think the better way, in my view, would be to do a little bit of a tailor-made approach. I don't know any, I mean, I don't have a suggestion on one website over other. You will find a few online, but I think don't take a boilerplate template formulate your strategy and then weave that in the language. Maybe take some quick help, professional help as well. As far as the sweat tax is concerned, who will pay? It's really the commercial negotiation, Rajul. In this case, maybe the employer. See, you have to make the transaction work. If I am saying that, Chirag, I will buy your IP at 25 crore, but you pay 8 crores of tax on it, maybe Chirag will not agree to part his IP. So I, as an employer, have to sort of walk an extra mile. Maybe one example I've seen is that employers sort of fund it by way of a loan. So I give a loan of 8 crores to Chirag to pay this tax, and this loan is recouped over, let's say, next 12 months from the salary. So there has to be a need for cash flow, and this happens even around the exercise of the ESOP, that the employer has to make it work for the employee. Otherwise, it will be a useless exercise. Nobody sort of benefits from the ESOP. Mukta, I think there are a lot of questions around templates and video lecture series. I don't have any specific immediate answers, but maybe I can send suggestions. But there's plenty of reading material online available. I have no one recommendation. Uh, Company law allows different treatment for ESOP by promoter director. Yeah, so sweat can be issued to a director as well as an employee. ESOPs can also be given to an employee as well as a director, but company law carves out two exceptions for issue of ESOPs. The ESOP cannot be issued to a promoter. So this is a big sort of negative. And second, any director who holds more than 10% equity in the company. So really, to the key decision makers, you cannot issue ESOPs. They have to then fall into the bracket of or they have to be awarded through the sweat equity, or we will see some strategies, because there have been few live situations, and I'll share some case studies in the next session. We will in fact begin with this topic in the next session. So Mukta, this is it from my side for today. We can
Yeah. So regarding the reading material, probably there could be some interesting reads in the Venture Center library also. So requesting participants to feel free and drop in to explore that. And next time, probably, Ami, you can also indicate some reading materials in your next session.
Sure.
Yeah. So to alert everyone, this time we are going to have back-to-back Tuesdays. Generally, we do alternate Tuesdays. But our next session by Ameya would be immediately on the coming Tuesday, which is 15th of October at 4 o'clock. And that would be focused on ESOPs and SARs against, which is part 2 would be on strategies and best practices. So if there are no more questions, Ameya, we can stop here. And thank you for this wonderful session, and look forward to host you on the coming Tuesday on 15th of October at 4 o'clock. Thank you.
Thank you. Look forward.